the presentation. There you go. And the presentation deck that we use today will be sent to you. So don't worry about having to screenshot or scribble down notes. Okay, so let's get going. For me, as chair of an IPC and as someone who's had to review charities before our clients make donations and grants to them, I can attest firsthand that today's topic is particularly challenging for many charities, both on a governance front as well as with regard to investing, of course. So like me, I hope you'll benefit from the experience and expertise of this terrific panel. I'll now introduce them and invite them to turn on their video if they have not. I think everybody's video is on. And I'll read out a brief bio for each panelist and then have each one share a little bit on the perspective that he or she brings to today's discussion, okay? Let me first start with Ms. Chan Chia Lin. Chia Lin is a director of Lam Soon Cannery Private Limited and is also a board member, board director of Maple Tree Industrial Trust Management. She was previously the chief investment officer of Fullerton Fund Management Company and managing director and head of currency and strategy at Temasek Holdings. Chia Lin is active in the social service sector. I'd say very, very active. She is the vice president of the National Council of Social Service, chairman of HealthServe Limited, and is a board member of Mount Alvernia Hospital and Resilience Collective. She also serves on the boards and investment committees of several other charitable foundations and church-related organizations. Chia Lin chairs the NCSS Investment Committee. Chia Lin, can I invite you to just share a little bit of your perspective on today's dialogue?
Yeah, thanks, May, and thanks to CNPL for inviting me to join this webinar. I think the question of how to generate better returns than FDs has plagued many a nonprofit for many years. I think since the GFC, when central banks everywhere, embarked on massive quantitative easing and cut interest rates to near zero or to zero. The issue actually is no less relevant today. I think the issue is even more relevant today because while inflation had been, relatively low, averaging well below 1% in the last 5 years or so, today inflation is running at about 5%. So I think that the whole issue of how to generate returns and yet not take excessive risk, because as nonprofits, we are unlike in my previous life, where one is paid to take financial risk and amply rewarded for it. As boards of nonprofits, we are not. Yet we owe a fiduciary duty to the organization and to our stakeholders on how we should manage the money. So I think it's an important issue, and one that I think all of us, whether those on the panel or those listening in, I think it's something that we really need to collectively crack our heads over.
Absolutely, and thank you. We're gonna hold you to that, Chia Lin, in a minute. Okay, well, next on the panel is Mr. Ang Hao Yao. He is a private investor who has previously worked in banking and is active in the charity sector. Hao Yao is currently the chairman of Credit Counseling Singapore, a charity helping individuals and small businesses in debt distress. He also serves as the honorary secretary of the Securities Investors Association Singapore and chairs the financial committees of the National Kidney Foundation and the Sing Health Fund. He was also the former chairman of SATACOM Health, a medical charity. Hao Yao, would you like to share your perspectives?
Thank you, May. Well, I guess most of us here are in some financial function or other, like the treasurer or member of the finance committee. And you will know that aside from budgeting and financial controls, some of us also have to look after the investments. You have also have to decide, for example, how much goes into the reserves, what should be our reserve ratio and policy, how do we determine how much to invest, what to invest in, and then monitor those investments. Hopefully, we also don't get brickbats if the investments don't do well. The question would be then, how do these reserves feed into our operating budgets, or should it at all? Some charities use all the returns. Some feel that it should not be touched. So that's something we can get into today. And in this climate, we certainly have our work cut out for us. Most would have noticed that many markets are falling. And since the pandemic started, work from home and such technology stocks have been on a tear, including crypto craze. Now with inflation, logistic disruption, war, and the trend back to work from office, this is affecting equity and bond returns. So charities this year are caught in a high inflation and low return scenario. So actually this talk is very timely, and I'm sure they didn't think of that when they first scheduled it, but it is actually a perfect timing to discuss these topics. So I look forward to it.
Thanks, Hao Yao. I see 162. So I was telling the panelists earlier, we better behave. There are a lot of people attending. Let me turn things over to my colleague, our third panelist, Mr. Matthew Tam. Matthew is the head of Discretionary Portfolio Management, DPM, in Singapore, and has more than 20 years of investment experience, primarily managing discretionary portfolios for both private and institutional clients. Prior to joining BNP Paribas Wealth Management, he was head of portfolio management in UBS and at the Royal Bank of Canada, both in Singapore. In his personal capacity, Matthew has been on several boards and committees of non-profits such as Satacom Health, the Singapore Association for the Deaf, and Barker Road Methodist Church. Matthew?
Yeah, thanks, May. I think as what Hao Yao and Charlie mentioned, today's investing environment is becoming more and more complex. And as a result, a lot of the finance com or even the board of directors may find that, what should I do with the reserve? And how should I start even moving into investment? So I think with I have fortunate good experience able to sit on both sides, both on board as well as in the investment committee, as well as managing some of these reserve in my capacity in BNP. So very often I've seen how I have to work with all these board of directors as well as committee to start off even with doing an investment policy statement, and to explain to them how you decide then how you dedicate, whether you dedicate to third party or whether you manage it within, and whether if you're large size, should you go a segregated portfolio or should you go into mutual funds, or should you just do it yourself, which may save costs. And all these questions need to be addressed by the board and as well as by the investment or finance committee. So they are very, very interesting questions. And I hope later in the fireside chat that we may help to address some of these as well. So I think, but certainly reserve is something that that you want to use that to be to enhance the income, so that to use it for the expenditure of the organization that that we are there to serve. So I think it's important to step out, especially in today's environment where a lot of non-profit organization will find that actually the deposit, fortunately now it's been creeping up, is no longer sufficient to outbeat the inflation. So inflation today in Singapore, maybe it's 2.5%, but with a deposit rate much less than that, your real return is actually negative, which means your purchasing power in the long term is eroding. So as your spending keep creeping up, you need to enhance the reserve. And we have seen many organizations with strong reserve management policy able to use it to supplement very well their spending policy. So I hope that during this short 2 hours or 1.5 hours, we can help to share some of our experience and hopefully work together with the rest of the MPO on all these objectives. Thank you, May.
Thank you. In planning today's meeting or session, we had a meeting, the panelists and I, and we thought about how we would organize the discussion. So we thought we'd put Matthew to the test first and have him do a short presentation. We think that the presentation will help contextualize our discussion. He'll share some of what we see charities doing. I mean, we do work with quite a few charities. And on the back of his presentation, I'm sure all of you will have questions for him as you listen, and that might help crystallize and trigger the many questions I hope you pose this panel. So Matthew, can I turn things over to you? Panelists, if you want to turn off your videos, so for a little while so you can get some coffee. And then, remember that the slides that Matthew is sharing will be sent to everybody. So let's sit back and hear from Matthew for a while, shall we?
Sure, thank you, May. I hope within the next 15 to 20 minutes, I could share some lights on certain segments, and then before we move on to the fireside chat. Next page, please. So what I will hope to touch on is quickly an introduction of DPM in BNP, and then some of the charitable organization that we manage for. But in view of banking secrecy, I'm not allowed to disclose the names, but the nature of their kind, but in the general scope of the kind of their business, and as well as what are some of the general mandate that they invest. So I hope that by sharing this, it will be advantageous to those who are currently with their reserve mainly in deposit and still looking at what are the things that we can do to enhance making more good stewards of my reserve. So the second segment is an important segment, but it may be a bit boring and technical for those who doesn't like corporate finance, doesn't like financial management in university. Unfortunately, it's a little bit of those kind, but unfortunately, it's very important. And then thirdly, I would like to share maybe just one slide on an onboard journey that we have with a large community hospital, which themselves are very well run and very well established in Singapore non-profit organization climate. Okay, with that, I move on to the next page. And maybe next one. Okay, just a quick introduction. BNP DPM is one of the award-winning team that we have, and my team have actually won several awards. For 2020, we have won the best DPM team by APB, and 2018 as well, and then 2020 we also won the Private Banking International of the best DPM team, and several awards. So this award don't mean much, but it means that at least for those organizations that have been working with us together, they have seen and they have give testimonial of the closeness and the hard work that we have together with them. As I mentioned, even from starting of constructing an investment policy statement to running of it, and then setting up the performance measurement for performance review, and all these are important as well. Next page. Okay, this page just basically show that every dots that you see here represent a client own self-directed portfolio. But what you can see is that the discretionary portfolio management, the performance is represented by the green line. You can see that the DPM has actually outperformed almost 92% of client self-directed portfolio over a period of 5 years. And if I turn to the previous 5 years, the same scenario happens. So on average, we have more or less double or triple the performance of client self-directed portfolio, which means they make their own decision. So some participant or some audience may ask, oh, does it mean that the clients are not clever, or they are not wealthy, or they're not wise? The answer is no. One of the topics that I want to bring about is actually behavioral finance. Very often you see that when clients, like for example, in this period, when the market drop a lot of the client will start to get jittery, and some may even say, oh, let's cut loss and whatever, or some may suddenly get frozen and do not know what to move. So these are all the behavioral finance where people get overconfidence, and some clients profit take too early on the winners, and then when come to loss-making position, they cut loss a bit too late. So these are all the discipline that you must have in order to have a systematic, constant upward return over a medium term investment horizon. Okay, next page. Okay, next page maybe. In view of time, I want to skip. Yeah. Okay, this page is show you that we have managed about 23 non-profit organizations in addition to all the other family office that we manage, or even high net worth. But in non-profit organization, we have about 23. And that includes things like hospitals, charitable society, clan association, cooperative society, country clubs, family trust, some educational institution, and religious organization as well. So it's very interesting to work with the various of them, and some of them are mid-size, some of them are large size. So we do work with between mid-size and large size kind of non-profit organization. In terms of breakdown by strategy, you can see that many of the clients have actually oriented towards more a pure bond mandate. As most of them, their first objective is that currently my deposit is, let's say, 0.5% and 1%. So what should I do in order to enhance it And so the first move usually for them is to go into a bond mandate, which maybe then the yield to maturity or the average return per annum to maturity is maybe about 3 or 3.5 or even 4%. So with that, it can really further enhance them versus the term deposit. So usually that's the first move that I see many MPOs do. And then of course, followed by multi-asset portfolio like conservative, where you have 20% equity and then the rest in bonds, or a balanced mandate where 50% are in bonds and 50% in equity. A smaller number of clients actually have pure equity and dynamic mandates. But most generally, why they do have that is because they perhaps have two portfolios, a more conservative one and then a more dynamic one. I have seldom seen clients, non-profit organization give us the first mandate is a pure equity mandates. Although, as I mentioned, in the overall asset allocation, it could be possible, but not as the start point when they first invest. And then by breakdown of size, for us in BNP, certainly we manage a bigger size pool, those 1 to 5 mil, and those 5 to 30 mil, we have about 32%. And the rest of them are actually much bigger size mandate as well. But certainly, this does not stop any non-profit organization to think that if they want to move on forward, that they can go into even investment size of 200,000 or 300,000 or $500,000. There are investment vehicles that if we have a chance to speak about in the fireside chat, we can then share on that. So certainly all these are also possible, even for the smaller organization. Next page. Okay, I want to touch on a little bit of importance about strategic asset allocation and behavioral finance. And forgive me that I may have to move a little bit faster in view of time. Thank you. Okay, here the importance of strategic asset allocation. Here you can see on the medium, you can see that the bonds, there's a horizontal line where you put 100%, 90%. So if you look at the first one, which is 100% bonds and 0% equity, on average, the return is about 5%. But on the middle, you can see a 50-50%. The average return is about 7.2. But yet you can see that while it's balanced, 7.2 is the average. You can see that actually the range, it can go to -23 or it can go up to +26. So as you added more and more equity, the variation of the return will deviate from the average mean. So this is also important to see where your risk tolerance before you decide on your strategic asset allocation of how much in bonds and how much in equity. Certainly, if you look on the extreme right, then you can see the average return of equity could be 8.7, but it could go up all the way to 34%, but it could be a certain period that it dropped to -38 as well. Okay, next page. Okay, so what is the most important in driving the portfolio performance is actually strategic asset allocation. Very often I see clients discussing, oh, do you think this is the best timing now to go into equity? Or do you think it's the best timing to buy Alibaba? I thought all these questions, if you look at these charts, is less important than if you answer correctly in terms of your organization, where do you want to set your asset allocation, whether more equity or more bonds or what is your risk tolerance? These are the more important questions that all the board and all the investment committee or finance committee need to address when they embark on the reserve management policy. And then, of course, here you can see market timing is only represent about 7%, but more important is strategic asset allocation as well as tactical asset allocation. These are the main drivers when it comes to return. Next page. Okay, here again, you can see that if I just put on the top of EM equity on the left-hand corner, you can see the brown color never repeat on each of the year. And gold as well. If you look at gold on 2010, it was the top in the best performing, but then in 2011 it repeated, but after that you can see it doesn't repeat again. So it shows you again that a lot of investors try to pick last year winner, and this strategy usually does not work out well. Therefore, a diversified portfolio is better to well positioned to take advantage of the very returns. Okay, next page. Okay, here again of using too much on market timing. You can see that on the left-hand side, for a client who invests totally, let's say on US equity, they generally get about 6% return per annum. But for someone who try to market time and miss the best 10 days, their average return from 6% will drop to about 2.44%. And very often, the best 10 days usually come from the worst after going through the worst 10 days. So therefore, sometimes it's better to keep yourself invested. You can do a tactical asset allocation of overweight and underweight, but you should not think that you can time in and then time out and get out first and then go back in. So this kind of market timing history has shown that it doesn't pay off. Next page. Okay, what are some of the value destructive behavior that I see on many of the committee is these three areas. First, is not paying enough attention to asset allocation, and they did not spend enough time discussing on the asset allocation first, and then having too much money in one investment, over concentration and not diversification. This is one of the biggest error as well. Sometimes I hear that they maybe invest into one of the bond, and then the bond go bust. So this over concentration is also not healthy. And also, as I said, one of the area of behavioral finance that people suffer from. And then lastly is trying to time the market, thinking that they can get out of equity, like now with the market winners totally get out and then totally get back in. So this kind of timing is also not easy, and often it doesn't create value, but it's value destructive. Okay, next page. Okay, here again shows you that if you look at the first top, you can see that when the equity market is at the top, the stock mutual funds inflow is at the top as well. But on the other right-hand side, you can see that when the market dropped to the bottom, it's also where people withdraw the most. But in fact, the opposite should be done during the market when it's at the bottom or at the weakest or the most fearful time. Is where you should slowly nimble in to invest. And so, but it's easy to repeat this discipline, but it's always not easy for sometimes the committee to actually follow through this process. Okay, next page. Okay, what I want to show on this market timing fantasy is that if you can see on the blue bar, actually is S&P 500. So although you can see that in 1 year, you can see that the fluctuation or the variation of the return is very high. But if you go to the 10 years, you can see that the average return remains the same, about 10 to 12%, but the variation now becomes smaller, between -2% to 20%. This shows again the importance of having sufficient time frame. When you invest, be it on the bond or be it on the equity, you must give yourself some a reasonable time frame of, let's say, 5 years or even 3 years minimum, so that you can see through a cyclical period. Very often, sometimes I see that committee or board wanting to try to, as I said, move in at the thinking that they can bottom pick and then get out during the top and not able to hold for a long period of time. So, for example, in 2008, where equity market dropped 50%, if for those that decided, investors who decided to get up during 2008, they realized that they missed out the 50% run in 2009. And then within a year and a half, the client will have recovered and go back into a normal annualized return if they have held on. Okay, next page. Okay, I'll skip this as well. Okay, yeah, I'll skip this as well. Okay, now I just go to the last page and the last segment. Next page. Okay, here I would like to just share a little bit of thing to set the groundwork for the panel discussion on how we have on board a large community hospital, which is very well established in Singapore. In view of the privacy, I couldn't name this organization, but it has very well established board of directors, very well established committee members as well, which we've done a very good job in Singapore. So the first thing we have discussed together was what is the investment policy statement and what are some of your investment guidelines. And so they may discuss things about the currency policy, they may discuss things about what is their risk tolerance, and then subsequently we discuss whether can this go in-house or external manager, whether if it goes in-house, whether the finance comm or even the finance or accounting department have the ability to do that, or even the board of directors, whether do they have the ability or the time to actually manage it in-house. And if not, then external manager, and what are some of the criteria. Then we go through things like, should we go through mutual funds or should we go through segregated account? When you go through mutual fund, of course, it's smaller amount, but segregated account, then you have the right then to put in some constraint or restriction that if you do not like them to invest in sinful industrial, you can tell them that no gaming stock, no tobacco and all those, but you can't do it if it's in mutual funds. And then the second step is that you send out then the request for proposal. You put in your criteria and then and run through a beauty contest. So in this request for proposal, it must be very clear what is your expected return and what are some of your guideline and policy, whether the bonds need to be all back into Sing dollar and whether they need to be all 100% investment grade, whether you allow them to go into government-linked corporation or some organization restrict them to only investing in statutory bonds or government bonds. So these are all the things that will be spelled out clearly when you do a request for proposal. And then the third step is that during this beauty contest, you have the panel will then have to evaluate the experience and the track record of the fund managers, the investment process, the ability to generate alpha, the ESG consideration, and also performance reporting and updates. So, and with that, then of course, the few selected managers are awarded, and the organization will announce the duration of the how long this contract is given to them, and the performance measurement, and the and as well as the portfolio review as well. The scope of the investment mandate must also be clearly spelled out. Whether is this going to be conservative mandate, is this going to be balanced mandate, or is this going to be pure bond mandate? What is the minimum and maximum of equity, or minimum or maximum of bond must all be spelled out clearly. And then fifth step is to do a regular portfolio review of macro, recap of whether the policy or the process is in line with your investment policy statement as well. And then, of course, the performance measure against the peers as well as the benchmark. And then lastly, step 6, whether you want to add money if they perform well, or whether you want to change the managers. If you find that no longer they are in line with your investment policy, or maybe the integrity of that fund management unit is no longer that you felt that they're doing a good job. So all these are the things that we go through in the whole journey as we move together with this community hospital. I think with that, I will end here, and May, I'll pass back to you. Thank you.
Thank you, Matthew. I see questions from Lloyd and from Ardi. We'll get to those questions, I promise you. I'll make sure I post them, when we're focus on these ones. But we really wanted to share that we will be focusing on 3 areas of discussion. We will be, sorry, I forgot to start my video. So we will be focusing on 3 areas of discussions: governance, macro outlook, as well as reserves management. It's really hard to sort of talk about one without affecting the other, as you'll see. But to kick things off, let's get a sense from how you guys are sensing the economic climate at the moment. We really want to do a poll question to see whether you expect that inflation will affect your budget this financial year. So if you would just select between the 3 choices. I have Arthur helping us, beautiful. Just click and decide between not at all, or moderately, or you think inflation will strongly affect your budget. If you make your choice, we'll see how you feel in a second.
Cause you're a sky full of stars. Cause you light up the park. I don't care, go on and tear me apart. I don't care if you do. Cause in the sky full of stars, I think I saw you.
Okay, Arthur, can we see what people feel about how inflation is going to affect us? Okay, so very few say not at all. I really want to know which ones those are because we should be looking at the model. But moderately seems to be the prevailing choice of 61%, and some even think 34% of us think that it will strongly affect. Thank you for that. That gives an orientation of how we're going to respond. But, as you gather your thoughts about what Matthew just showed us, let's start with some bit of a chit chat with our panelists, okay? And please continue to send in your questions on the chat or the Q&A function, and I'll aggregate some of these questions and pose them to the panelists. So, Chalin, if I may put you in a hot seat for now. So with the inflation and rising interest rates, what should MPOs do with their reserves? Do you think, keeping it in fixed D as many charities do is the way to go today's environment?
Yeah, May, I think before we answer the question, I think that the first question to answer is whether the charity can actually take any investment risk. And I'm just going to assume that the charities who are participating in this webinar have sufficient reserves. I think usually I would say that, you should only put at risk the reserves that you have in terms of investing in risk assets, money you do not need in the next 3 to 5 years, because as Matthew said just now, you need to be able to ride through an investment cycle because you don't know when the next big shock is going to come. So I think that's the first thing. And so I think if you have an investment cycle of 5 years or more, you can look at if maybe you don't have, maybe it's 3 years, then I think you can still go beyond FD, but probably better to just look at bonds. And I think with having said that, it doesn't, I'm assuming that people have excess reserves that they don't need, in the next 12 months. And I think we should look beyond FDs. Although FDs are on the rise, inflation has risen much faster. So, we used to always think in terms of targeting nominal returns. I think investment committees and boards all over need to have a mindset shift to thinking about targeting real returns, or at least to targeting to preserving the real purchasing power of your reserves. Because if you leave it in FD and if you've got inflation running at 5%, okay, maybe it's not going to remain at 5%. It's going to go down to like maybe 2 to 3%, but that's still a lot higher than the 0 to 0.5% we saw in the last 5 years. So I think we should look beyond FD. Then the question is, I guess, what we look at. I think the good news is that I think with interest rates having risen in the last few months, short-term bonds maybe start to look more interesting now. I mean, I think you can buy a 5-year, let's say, PSA bond and an investment grade, very safe bond and get about 3%. Or you want to be even safer, right? You can buy a 2-year Singapore government bond for over 2%. And I think, that would actually be better than putting your money in FD.
Thank you, Chalin. Yeah, we had a chat about this, and it is hard because, before we even think about investments, we do need to think about how much we can put at risk. That's why I say it's really hard to sort of take one area of our discussion at a time. Matthew or Hao Yao, did you want to add to what Chalin had to say? Hao Yao?
Well, I think Charlene mentioned that, in this kind of environment, you do have to invest. And I also get questions, and not only from charities, but I think even from individuals, because there is an inflationary environment. But yet, there is a big gap still between inflation of 5% and, your government bond or fixed deposit of 2%. So the question then is, what do we do, right? And we have to first decide if this is going to be a long-term event, or is it going to be shorter term. And if it's a shorter term, then what we still need is income generating assets, be it equity or bonds. And we hope that this gap between that and inflation doesn't go on for a number of years, because it's possible that it's partly due to the war and maybe the pandemic and some logistic disruptions, and hopefully this doesn't go on. At least we don't expect this to go on perpetuity. So soon there should be a period where investment should outperform inflation. That would be back to the norm. High interest rates, what we call high today, I recall in the 90s in Singapore, interest rates were about 5% or so. So I don't think it's high historically, but it's high compared to maybe the last 20 years.
Yeah, hi, maybe I can just add a little bit. I think as what Chia Ling and Hao Yang mentioned, because of the inflation, it's quite important that we've been good stewards of the reserve to really think beyond just fixed deposit. So let's just give a scenario of someone who currently have only 1 million in the reserve, and I mean in a unrestricted reserve where he can actually use it to put into investment. If he have done that since 2012, today he will have got maybe 1 mil to become 2 mil. And if he have put it just in a conservative bond, he will still be able to get at least to about 1.5 million. But however, if he's only in deposit, I'll say that maybe he will get only about from 1 mil to 1.1. So it shows you again how much additional extra you could have generated if you put into a reasonable, not even high risk investment. And so I think that's one of the key. But of course, in between these 10 years, there's always a bit of volatility, even for bond. And we've seen even in 2018, bond have there's 4 interest rate hike in Singapore, and the bond market was actually a drop as well, maybe flat or maybe plus 0.5%. But the next year, actually the Sing bond market actually rebounded back strongly to about plus 7%. So if you average 2 years, you still get about 3.5%. So it's still not too bad if you versus your deposit of 0.5 then or 1%. So this just shows you in a very simple nature of thing. You can still enhance without, as what Chia Ling mentioned, not to take too much risk. Because if you don't have the risk appetite, you cannot take too much risk, but you should learn to step out of that and go slowly into some part. And I often see many of organizations, they usually start with 30% of their deployable reserve. So not the full thing, just do 30% first. You test it out, get your policy statement properly, and get your review panel properly. And then once you do that, then you start nibbling more and more. So this is what I see. So I don't foresee that this very difficult currently investing environment it is extremely negative things with no bright spot, because the bright spot is that the interest rate are going, which means your corporate bond yield is moving up, your government bond yield, as Chia Ling or Hao Yang mentioned, the 2 years is at 2%. Even buying a simple 3 years corporate bond, you can get 3.5%. And it could be CityDev or UOB. So it's no different from if you have put in a UOB bank. Of course, one has deposit insurance, the other don't have. But it shows you that these are very, very small moves that you can incrementally discuss, and then eventually that you can move forward and to enhance and to try to outbeat the inflation. Okay, with that, maybe I hand back to May.
May, if I could add on this point, I think maybe this is for investment committees or boards who are already currently investing. I know we're here talking about not taking excessive risk, but I think over the next 3 to 5 years, the long-term returns to risk assets are probably going to be lower than they have been for the last 2 decades, where the last 2 decades were exceptional times where you really saw the benefits of globalization. Central banks brought interest rates down to an unbelievable level. I think that's not going to be repeated. In fact, we're deglobalizing, and the global environment, I think, is going to be very different. If you can't get beta returns, that means market returns, then actually you have to try and get returns from alpha. That means from the manager's skill. And on this score, I think a lot of us have typically viewed hedge funds as being very risky, as a very alternative asset class. But I think that some institutions who maybe have much larger reserves might want to think at absolute return strategies where the fund manager is given more leeway to manage a portfolio where he can maybe try to generate more alpha. to get the returns.
Thanks for that. I'm going to depart from our plan simply because we have some nice questions coming in, and we'll just take it as we go like that. Matthew, just a quick one because Lloyd has a couple of questions. His first one was in your examples earlier. Were the bond investments mostly in government bonds or corporate?
Yeah, I think the key first is in deriving the investment policy statement. The board usually have their own government policy. So, for example, in certain cooperative society, they're not allowed to go beyond government bonds and statutory bonds. So, as a result, because of their governing policies, then we should abide by that. But assuming that the organization itself, the non-profit organization, doesn't have any restriction and would like to invest in bond, then I would say that certainly as wide as possible should be the scenario. Always allow your fund managers or allow your company to open up to both government bond as well as corporate bonds. Government bonds, usually the yield is much lower than corporate bonds because you have to take a corporate risk. But in Singapore corporates, a lot of people have two myths. First myth is that they are not liquid. You cannot buy and sell. Today, we are managing close to about $500 million for some organization in Sing bonds. And I remember in the month of December, we need to generate about 70 million for one particular organization. And we managed to get out 70 mil of Singapore corporate bonds. So liquidity is there. And therefore, it is not true that you cannot invest in corporate bonds. You can get out. There's the liquidity of corporate bonds is still T+3, which means if you sell, you still can get back your money 3 days. So if you would like to get it back within 7 days, 10 days, it's more than enough time for you to be able to put that. So I'll say corporate bonds usually generate a higher return than government bonds. Government bonds do well when there's a flight to quality. For example, in flight to quality like US Treasury, they actually move in. Otherwise, I'll say that corporate bonds usually are safe enough. And in Singapore, especially for corporate bonds, there is a safety gadget in the sense that a lot of the insurance company, a lot of the big MPOs, a lot of the institutions, we buy government corporate bonds. So we tend to hold them, and whenever there's one that comes out, usually there's good demand for them. So I think corporate bonds is good as well. Yeah.
Okay. We will have some more questions coming in about the reserves management itself, but for those of us who are not maybe so fluent in this, and we will need a lot of help from our bankers, to get us, a little bit more comfortable, let's maybe go back a little bit and talk about how we can organize ourselves around, being better prepared, to get an investment policy. Maybe Hao Yao, as a very experienced board member yourself, and Charlene also, what does it take to put a sound investment policy in place? Now, we also mentioned, I think, in the conversation before, that often it's about the personalities around the table, around the board table, right? So how do you, manage that, and what does it really take, to get sorted before ready, as Matthew has ably, illustrated for us?
Well, typically charities put all their financial people into a finance committee or investment committee. Some combine both, so that's also something you can discuss. The benefits of combining or being independent. And usually on the finance side, you have the finance executives, the academic lecturers in business and finance, or you could have people in banking and auditors. And on the other side, the investment committee would be fund managers and such. So as you mentioned, it's sometimes the personalities. When you put them together, they have more responsibility as a whole. But bear in mind, some may not be familiar with the others, right? So if you're a finance person, you may not have done investments and vice versa. So it really depends. People willing to do that, come together and look after both. So it's also partly their appetite for doing so. And then after that, you have to think, of course, work out your budget, and as Charlene said, you have enough in reserves, and you don't need it for several years, and then you decide to invest a certain amount. As Charlene also said, charities start from the standpoint of all in fixed deposit. So in order to move that, again, it's personality of the boards and so forth, whether they are willing to, as a whole, agree to do so. But often you have to take baby steps. So they may be willing to start with, a few $1 million. And with a few $1 million, you cannot hire a fund manager like Matthew, probably. So you will, and I've seen charities, and what they do is they buy specific funds. So maybe $1 million in an equity fund, $1 million in a bond fund. So you get some diversity, you get a balanced portfolio immediately. But then that would mean the investment committee is making decisions, right? It's like practically stock picking decisions. What funds you buy, and Matthew also mentioned it's a beauty parade kind of thing. You have to meet a few of them, and they'll say this is suitable for your charity, and so you have to pick a bond fund here or two, and an equity fund here too. So that's a few $1 million. That's usually what how charities start investing. But when you reach maybe 15 million, then you will look for perhaps a dedicated fund manager, but perhaps like a Matthew, right, who was showcasing the kind of non-profit organizations he's managed money for. So you have one dedicated fund manager, and then the investment committee then oversees that, right? They review the fund manager every 3 months, and you see how the portfolio is going, whether to make any tweaks or not. When you make that jump, you also have to decide about your equity mix, right? Do you want 50-50, 60-40, and 70-30? And that comes about partly from your needs. So if your charity needs a certain return to fund their operations every year, right, then you work backwards and you say, okay, maybe I need 4%, right? And then the question comes, are you going to invest, going to use all your returns for your operating budget, right? And that is pretty risky, because if you depend on a 4% return and that's already budgeted in, and if you don't get that 4%, then you have some trouble, right? So it's not wise, obviously. Now, the other, on the flip side, not investing or not using any of your returns, right, and investing all your you don't touch your investment, so you let it roll, right? You compound your investments, right? And of course, that's a very happy situation, right? Because you never have to touch your reserves. And I think there are organizations in that scenario. It's like totally for rainy day. Okay, but I also find that's a big question mark. I mean, should you really be just reinvesting? Maybe you're not expanding your organization enough. You could be serving a lot more people. So where's the balance, right? It's a different answer to different organizations. But if you take from the government, where Charlene was, there's an NIR, right? A net investment return, where they establish a long-term return for their portfolio, and then half is used for operating budget. So 50-50 is always easy to agree on amount. And I think charities can also use that as a kind of a guideline. So when your return is 4%, you can take 2% and budget it for your operational use, right? So that's kind of how we can possibly organize ourselves.
May, if I could just jump in here, add on to what Howie was for sharing. I think, yes, in terms of board composition, I just want to, add on that if the board has decided that the money, can be invested, or the reserves can be invested, I think it's very important to actually make sure that you co-opt, or you rope in people with fund management experience, and not just people with finance experience, because I think, you may have finance experience, but if you don't have fund management experience, I think you look at things very differently. So I think it's important to pull in people with investment experience. And if the reserves are large enough, then maybe incorporate an investment committee. Then I think the other point I want to make in terms of, having decided that you can invest your money or a portion of your reserves, what should you invest in, or how should you invest it? What should be the strategic asset allocation? As Matthew rightly said, that's one of your starting points, right? Deciding on the SAA. Here, I think I would like to offer a slightly different view. I think as a non-profit organization, and knowing how the bias is towards conservatism, because you really are not, incentivized to take a lot of risk. My starting point would be, what is the maximum risk I'm willing to tolerate? What is the mark to market, the loss the board is willing to accept for the organization and its stakeholders? Is it 10%? Is it 20%? Is it 30%? Having decided what that mark to market loss in a worst case scenario we are willing to tolerate, then you go and work out, okay, so if I'm willing, let's say, to tolerate a 10% mark to market loss in a worst case scenario, then the consequence really is I cannot take too much equity risk, right? I mean, maybe max 15% equity risk. But if I'm willing to tolerate a 20% loss, then maybe I can go up to like a 20% equity risk. And then you work out, okay, if I take 20% equity allocation in my SAA and the other 80% is in, let's say, investment grade bonds, what are the long-term returns of this portfolio likely to be? Okay, is it going to be 3 to 4%? Is that enough for me? If that's not enough for me, then you have to iterate back and say, then am I willing to accept more risk? So I think you always have to be very clear what your risk appetite is, because it would help you when the bear case comes. Because then you are more likely to sit there and not panic and throw in the towel at the worst possible time. So I think that's important. And then the last point I want to make on this is really, if your reserves can allow you to hire a fund manager, please do. I don't think part-time investment committees, even if filled with very experienced investment professionals, can pay sufficient attention to the investment portfolio. So if you are able to, let's say if you only have $1 million to invest, then I guess you could buy, let's say, an investment grade bond fund, or you could, I suppose, buy 4 bonds to diversify. But if you have, let's say, 15 million, 20 million, and you can find a fund manager who's willing to manage this for you, then I would encourage that. Because anyway, as small time institutional investors, whether institutional or individual, you will not get the best pricing. You will not be able to access bonds. And this is particularly important in the Singapore bond market, where actually supply is very scarce. And institutional fund managers will get the bonds before you do.
So Chalin, if I can hold everybody to that, Matthew, if you want to probably add on, there are some questions coming in on precisely this. One, it's not very easy to populate our board, right, with people with that kind of experience. And, a lot of the boards are saying that they're going to look outwards for that. And, even though today's audience is primarily charities with larger receipts, right, 5 million and above every year, it could be that they need to hold a lot of liquidity. So they might have, even less than $1 million, maybe, 500 or 800,000 for investments. Could you perhaps, make a couple of comments for these guys as well before we move on?
Okay. Yeah, maybe I can add on that. As I said in the beginning, it's not true that only the large charity of 10 mil targets or 5 mil to above, then you can invest. In fact, I've been helping out one small organization that only invests less than $500,000, but that's on my volunteer basis. So we help them as well. So you can actually invest even with lesser amount. As the key mentioned, first you must derive your investment policy. So like your investment objective, your time frame, and then based on all the simulation, what is your approved asset classes that you allow the managers to invest in? And then, of course, your currency policy, whether you want everything to be packed back to Sing dollar, or you allow 30% in non Sing dollar. Your risk tolerance, that's the most important. And then, of course, any constraint because of some, if it's for some religious organization, usually they have some constraint. No tobacco, no gambling, or something like that. Then the frequency of review, and then the review, and then the performance review frequency as well. But one of the things I realized that once you have the investment policy statement, one of the other points that I want to point out is that a lot of time, the board or the investment committee or the finance committee, as mentioned, sometimes they are not really ex-fund managers, or they are finance, they could be accounting background. they may then decided to intervene. So they say, hey, I see that you're buying China bonds. I heard that China bonds has been dropping year to date. Oh, I think you should get rid of all the China bonds. Oh, I think why didn't you go to Europe? I think Europe is very cheap now. So when you start interfering, I think then there's a danger that that it's very difficult to then determine whether the performance is the fund manager's performance, or is it the investment committee or the board of directors committee. So I think there's a very important that you do not intervene unless there are certain things that you foresee danger. So for example, if you set a policy that you must have at least pegged back to Sing dollar, and if they're going to violate that, I think this is something to remind them. And if you see that the standard deviation or the risk tolerance has gone beyond what you created a risk budget, let's say you say that I want a standard deviation not cross 6%, and then you can see their portfolio are getting very volatile. You can then ask them, are you abiding by it? What are some of the measures you are reducing the risk? So, or if they invest all into long-dated bonds, you can question, oh, do you think that you can do an interest rate simulation to let me see that if interest goes up, how would your portfolio be impacted? How much will we lose? What is the maximum drawdown? So these are all the questions that you should ask, but you should not dive in and manage for them, because otherwise, there's no point for dedicate out to external managers. I think that's the 2 points that I would like to bring across. May I pass back to you?
Sorry, I have multiple things open because you guys are drawing a lot of statements. I assure you, mostly very good. So, I just want to share something that Brad is saying, Brad Levitt. He's saying that as both treasurer and investment committee member, as well as a fund manager in his day job, he echoes what Chalin says. One of the biggest pressures he has is to start, how do you start investing when you have less than 1 year of operating reserves? And many of the other board members are not very sophisticated, but have heard a lot of, a flurry of things from other people, right? I mean, that's the biases that we bring, to the table. And it's very hard to manage this. So he hasn't really found a guide, such as Chalin suggested, as to what level of reserves you should have before you go beyond FD. The other thing is, there are questions, Matthew and the rest, about the range of fees charged by investment managers for a small portfolio of less than $1 million, and do non-profits get any kind of concession, that they will be charged less than for-profit entities? Let me just stop there and have you guys react to that, and then we'll go on with some more.
Sure. I think as you pointed out, I think for most institutions, especially for us, serving the non-profit organization is a service for us to return back to society as well. So in our organization, we have often advocate to have a preferential management fee rate, which sometimes is even all-in rate, so that we give we help to manage them less than half of the management fee that we usually charge other organizations. So this is what we do for them. I see some question as whether there's sometimes there's insufficient people. So I'm sure there are people like I myself and Yao Hao and Jialing all sit on several committee, and I'm sure if there's a need for some help, we can always refer some of our peers in the industry or even myself to help out as well even after this session. So many of us are very willing to help non-profit organizations who themselves the institution are serving the beneficiary. So I think it's our job that we can guide and share whenever we've been approached. Thank you. Sorry, there's a lot of questions, so I'm sure I missed out some questions as well.
No problem. That's really quite a bit. Some of the questions are themed around, what to invest in, right? And I have 3 people asking about, is real estate something that should be considered? Chalin, would you like to? I see you're ready to.
I can just say something real quick about that real estate. Well, it's a low-hanging fruit, if you ask me, particularly if you're renting property right now, right? So if you were to buy a property with your, let's say the 10 million you have, and you save your rent, so straight away, actually, you're getting a return. So there is some logic to that. However, you have to decide if you're able to diversify and have other investments as well. So you don't want everything in the same boat. Secondly, it's a liquidity issue, right? If you suddenly need funds, right, then you can't sell part of a building, for example. then also your operations may not stay the same size, right? You may eventually expand or you may contract. Then that property becomes, may not be so useful anymore, or you may be in the wrong location, for your activities. So these are things you have to consider before you delve into any property. Of course, I've seen charities who have bought properties successfully. I've also seen charities who don't buy and just rent successfully. So there is no, definite answer to that question.
I think if I could just chime in here, I think I would be very careful, before, advocating for charities to go and invest in real estate. I think, first of all, the returns to real estate investing, I think looking forward the next 5 to 10 years, probably will not be the same as what it's been for the last few decades. I think government policy has suggested to us that government does not actually, encourage, excessive increases in property prices. That's one thing. But the point that Hao Yao just made about, your operations may not remain the same. What may be a need today actually may not be the same need tomorrow. So if you have sunk your reserves into a relatively illiquid asset, then it's harder to manage and harder to maneuver. I think, if one wants to have some exposure to real estate, one alternative may well be actually the real estate investment trust. Having said that, that's not quite the same as real estate. You are subject to equity market volatility. But if it can be part of a portfolio of, let's say, high dividend equities portfolio, if you have one that you farm out to external fund managers. I don't advocate that actually boards or investment committees go out there and stock pick themselves.
Yeah, I think on the ground of the illiquidity of property, as mentioned, unless you're using it for your own purpose, then you could benefit from the capital gains subsequently as you continue to use it. But otherwise, another alternative that I do see some charity use is actually real estate investment trust. So those that the dividend are about 5 to 6%. So I do see some people investing on that for the benefit of a regular recurrent income. But at the same time, when there's a rise in the property prices, they will benefit as well because their net appraisal value will actually goes up, and as a result, the capital prices of the real estate investment trust will actually move up as well. So this is also one of the sub-asset class of real estate that people can look at.
There are many questions and some are very specific, right? So I'm actually going to make my colleague, I hold my colleague up to a little bit of pressure. I'm going to suggest that some of these guys with very specific technical questions, reach out to you. We'll be sharing contact information, Matthew, later. But we'll stay with a little bit more of a broad set of questions for now. And some of the requests are, how you talked about setting performance benchmarks, right, for your fund managers. And can you give us some guidance as to the kind of benchmarking that we should be looking for? What is fair and what is appropriate?
Maybe I'll just start up on this. I think in terms of benchmarking, there are two types of benchmarks. One is an absolute return benchmark and one's a relative return benchmark. On the absolute return benchmark, it could be setting, having decided what is your risk tolerance, then you sort of set your, and then working out roughly what sort of return that's likely to get you. Then you set your fund manager an absolute return benchmark of, let's say you want to generate 2 to 3% over, 12-month FD, for instance. The other, of course, is a relative return benchmark, where, let's say, your strategic asset allocation is 30% equity, 70% investment grade bonds. Then you set that as a relative return market benchmark of 30-70. But you also need to determine, of course, for a relative return benchmark, even for an absolute return benchmark, what is your investment universe? Are you going to restrict your fund manager to investing only in Singapore equities and Singapore bonds? Or are you going to allow your fund manager to go beyond Singapore to the rest of Asia or even global? I think to the extent possible, you should give your fund manager more leeway to manage. Having said that, I think for charities where actually your expenditure is all in Sing dollars and your liabilities are in Sing dollars, the portfolio should not take excessive FX risk. So typically, what I think institutional investors with lower risk appetite would do would be to, let's say, the portion that's invested in bonds, you fully hedge the returns back to Sing dollars, even if you allow your fund manager to, let's say, invest in US dollar bonds, where the market is larger, because the currency volatility can often overwhelm the returns on bonds. Less so for equities. So, quite often people will leave the equities exposure unhedged, but for bonds, they would tend to fully hedge the bond exposure.
Yeah, maybe I add a little bit on that, on the benchmarking. I think in addition to what Chia-Ling has mentioned on the versus absolute and relative, sometimes I would like to also create a small scorecard for them to also measure the risk that they've created. So standard deviation, how much maximum drawdown you've done this time, and in the percentage of the months, how many times of the percentage are you positive? So to me, these are quite important because I feel that we want them to maximize the risk-adjusted return. We don't want them to just maximize the return because, especially for MPO, we are more concerned with the big drawdown. So I pay a lot of attention, and then also the integrity of the fund management unit, whether there's high turnover. If they keep changing managers, I think it's a red flag to me, and also their process, whether it's a rigorous process. So I think all this should be a little bit part of the review or measurement, in addition just looking at the top line number of performance. Why? Because sure, at one point of the year, one of the manager which have been doing very well will sure underperform. Because there's no way that this manager which keep to a certain consistent style will do well in every year. So, but you still want to keep them because they've been consistently not having big drawdown and consistently did well in their performance. So we should measure both return, as Chia-Ling mentioned, absolute return or relative, but also the risk must also be very careful on that.
Yeah, I would definitely chime in on that. And I think, risk-adjusted return is very important. And when you are, trying to decide on which fund manager to engage or to appoint, you should always look at the risk-adjusted return. Because they could have achieved that stellar return by taking on very, very large risk. So when you're comparing between managers, or even comparing on how they are doing relative to the market, you always should actually look at what the information ratio or what the risk-adjusted return is for that fund manager. And as Matthew said, then on an ongoing basis, apart from seeing how they are doing relative to the benchmark return you have set them to achieve, how they are doing, in terms of, keeping volatility down.
Can I slip a question in on currency exposure? Should we stick to core currencies or accept a level of forex exposure?
Okay, if you don't mind, I can start off first. Okay, I think for many of the Sing-based charity that I see, usually in the investment policy statement, they do put in that they would want at least 80% back into Sing dollars. There are some institution doesn't want us to invest out of Singapore. Even for the Singapore, even for the equity, they only want Singapore equity. But we've observed that in the last 15 years, except for maybe this year, Sing market has outperformed. But otherwise, the rest of the global developed market usually outperforms Singapore market because Singapore is a mature country. But nevertheless, it's not difficult for managers to actually do a hedge back of the overseas FX exposure back into Sing dollar. So I think it's prudent to still keep in their base currency. But of course, if the organization is huge and they have some use for overseas and then they have a US dollar pool, then there's nothing wrong. But so far I've seen even for the large non-profit organization in Singapore, I would say that mainly they are reporting currency are in sync. So as a result, it's better to be prudent. And don't forget, although you can buy a lot of US stuff, the hedging cost could also be rising. So we have to be very mindful of that. But hedging is not a very difficult process for many of the institutions who need to do that.
Charlene, did you want to add to that, Hao-Ya?
Yeah, I think as I said just now, I think typically for bond investments, I guess most fund managers would be investing in Sing dollar bonds for Sing NPOs or low risk institutions, and US dollar bonds, simply because actually the Sing dollar bond market, the supply actually is somewhat limited, and as one of the panelists mentioned just now, insurance companies just mop them up and park them away. So I think so on that, because hedging from dollars back to Sing dollars is very, the market is very liquid, and also because currency volatility is relatively high relative to actually expected returns from interest rates. It's good to hedge your foreign currency bond investments. In the area of equities, let's say if you're only investing in, let's say, the Sing market, or investing only in, let's say, US dollar equities, then if you want to hedge, you can. But if you're investing, let's say, in Asia ex Japan, sometimes it's very difficult to hedge some of these Southeast Asian market exposure. So I think if the exposure is not very large, then you could leave it unhedged, because the cost of hedging could be very high, even if you can hedge.
Okay, let me bring it to some questions on the trends in ESG investing, right? I mean, as charities, maybe some of us feel we should walk the talk, and even before we look at how we can put impact out there, perhaps we can look at positive impact from the way we invest, right? So would you guys be able to make some comments for us in terms of disabusing us of any kind of notions that we have around ESG investing, well, ESG and moving into sort of impact investing? Yep.
Okay, yeah, I can start off first as well. We're seeing more and more non-profit organizations or even clients, normal clients from family office or trust, requesting that some form of ESG has been integrated into investment products. I think it's more and more a common framework, and especially in BNP, ESG is our underlying be it a screening process or exclusion or be it integration, we embrace it quite intensively as a French bank. Regulation will also becoming more and more to ensure all these companies that we're investing abide by the ESG criteria. So for example, in level 1, we have things that like controversial weapon or even coal-fired kind of thing. All these are things what we call in the prohibited sectors, we will usually not invest. So we're seeing more and more, this is the first layer of screening. But on the second layer, we look into things like environment, social governance. We're looking for companies that actually score very highly into these 3 criteria. So these are things that more and more fund managers are looking into, especially as I mentioned in BNP. Every year we hold a forum called Sustainable Forum, and then we are seeing that it is becoming a mainstream, be it by regulation, and there's reward on that, because as this company get pay attention to their ESG or governance themselves, people are more willing. If you are a plantation company, you keep destroying the forestry, eventually we can't invest into you. We will not want to invest into you because the consumer will not want to buy you. We know that your sales eventually will come down. So there's a lot of meaning why we should invest into such company. And things may be renewable energy, and some may be green consumption. So these are all the themes that we are seeing in ESG that is evolving. And they not only are being environment friendly, but we are seeing that they appear to be very good investment opportunity as well in this area where it's emerging. Yeah, thanks.
It's definitely a growth area. And I think the good news, as Matthew said, is that, there's increasing emphasis amongst institutional fund managers on investing according to an ESG framework. So, there are dedicated, ESG funds, but even within traditional funds, increasingly fund managers are incorporating ESG, factors in their due diligence and how they analyze a company. So I think the trend is clearly there. And I think, as responsible, citizens in the nonprofit space, we should actually be trying to invest more and more according to ESG principles, as the supply of ESG mandates or ESG funds increase. And of course, if you are large enough to actually have your funds managed on to farm out a discretionary mandate, then you can specify to the fund manager what you want to exclude or include.
I'll just chime in real quick. Yes, clearly that's something investment committees are grilling their fund managers on, the ESG. And on top of that, as Charlie mentioned, you can also lock in your own, for example, if you're anti-smoking advocate, then you definitely don't want tobacco stock. So, but you also have to bear in mind that the more of these restrictions you have, the more difficult the job is of the fund manager, and it may affect your returns. The other thing about ESG is charities also doing their part in ESG, right? Are you looking at how you affect the environment, your reusable plastics, and so on and so forth, or are you still in disposable mode? So there's still some of these things, and charities should also look at themselves and try to report some of that in your annual report as well. What are you doing in the field of ESG? So not just about getting other people to do it, but also for ourselves. Just a bit of digression there.
Yeah, that's some good advice actually. So on my part, when I advise clients on philanthropy, I also talk to many nonprofits, sort of walking that sustainability walk, right? More than just talking about it is something that we're seeing that we have to integrate. I mean, even when you pitch to potential, sponsors and partners, I mean, you want to be able to say that you have not just some good thought, but some good practices in place. This takes us close to the end of the session. Before I turn over to Kitson, who wants to do a little bit of a presentation at the close, I'm going to go around and ask, if our panelists would come and share, sort of the one or two things that you really want people to take away from this, things that you haven't mentioned before, if you want to share. Hao Yao, can I put you in a hot seat and start off with you?
So some concluding points. Well, yes. Okay, well, as we might be coming to some kind of crisis, as you can see, the markets certain markets are falling quite dramatically. Whether this will expand, I don't know. But we have to realize as charities that there's always some financial crisis on the horizon, right? You would have known that in '98 there was an Asian financial crisis. There was SARS and Gulf War in 2003. There's Lehman 2008, and of course it was COVID. So our responsibility is to prepare for crisis, because that's when we need the budget, we need our reserves and so forth. So the best time to prepare for crisis is when times are good, right? So that's the time where you can, ensure that you have sufficient cash flow. So I always tell, finance committees that in the good times where fund managers doing well, you should ensure that you have in your cash balances or your fixed deposit enough of cash flow you can use for, say, a year. And if you are able to, 2 years, right? Because there's always a cycle, as mentioned by our fund managers on my panel. And the best time to prepare is then, because if you were required to sell your investments to fund your operations at a low, for example, if markets have halved, the $1 million you liquidate is actually $2 million, right? Which was 2 million a year before. Or for example, if the market recovers, then it's actually worth 2 million then. So money is very big when markets are low, okay? And you must be able to, as Matthew also said, ride it through. and not be forced at that point in time to start to liquidate to generate returns. So the best time to do is to prepare when markets are still fine and not wait till the crisis is upon us.
Absolutely. Chelin?
I don't have anything, I think, extra to add, but except I think to emphasize, I think one thing is really, as the board, or, you need to determine, okay, what level of reserves you need to use, okay, over the next 1 to 2 years. You should not actually invest the money that you need in the near term. Only if you don't need that money, let's say over a 3 to 5 year horizon, should you go out there and, take asset market risk. Unfortunately, I think that's it. And if you have 5 years, maybe you can have some equities. If you only have a 3 year horizon, maybe look at investment grade bonds. The other is, and I can't emphasize that enough, if the size of your reserves allows you to, please farm out the money to professional fund managers. Do not, stock pick and security pick yourself.
We hear you. Matthew, you want to wrap things up?
Yeah, I think that Yao mentioned that the market is volatile. But over the many years of experience, I also see that it's always during this time when there's market capitulation that people become fearful, but it's also when the opportunity arises. But I think the key has been a good stewards of reserve and a good stewards of money. It's not to keep them all in deposit. I've seen many institutions, even for individual, they've kept all the money in fixed deposit. Then they say, hey, how come this guy become richer than me and all this? That's because the guy invests and you have just put in fixed D. So I think being a good steward, sometimes we need to establish the step, next step to enhance the reserve. And of course, the amount of reserve and what kind of asset classes really depend on your risk tolerance. But the income that you generate from the reserve sometimes is very interesting. I mean, it really is part of the spending policy. And you can find that sometimes you'll be surprised that the amount of income that you generate is equivalent almost to the grant that you can get. And don't forget that the grant that we get from the government may not be perpetual. Whereas if you establish your own reserve management policy clearly and able to generate a regular income, be it 100,000, 500,000, or be it 1 million, and these are things that will be more sustainable. And of course, been thrifty on the spending policy, as if you generate 4% per annum, you should only use maybe about 2.5% of the extra that you have generated, so that this will make it a perpetual, a bit like Temasek today, how they run themselves as well. So I think with this, I see a lot more opportunity, and it should not be a hurried process. Even in investment, it should be a very long process of going very gradually. Don't think that you can move in and you want to see result this year. It's going to be a 3 to 5 years process. Yeah, I think that's it on my side. Thank you.
Thank you, Matthew. I want to say that Matthew and Hao Yao, Chalin have been just delightful to work with, as have, Kitson, Jansen and Arthur. You guys have been amazing at CMPL. I'm going to turn things over to Kitson for the close, and thank you, everybody.
Thank you so much, May. Well, I've learned a lot from this session personally, and looking at this session that we have conducted vis-a-vis the sessions that we conducted in the past, definitely a lot of our leaders are asking really, really relevant questions, and questions really close to our hearts when it comes to really managing our charities reserves. And definitely as board members, this is a critical topic. And of course, one of the key important lessons I've learned also, as what Chelin mentioned, please outsource this function. Yeah, I guess that as stewards of our charities, we may not necessarily be the experts when it comes to this area. So it's important to get the experts to actually help us to manage these reserves in terms of the investments. All right, and this is critical. So on behalf of the CMPL team, I would really like to express our thanks and appreciation to BNP Paribas Singapore for co-organizing today's Board Connect Forum with us. And of course, a big, big thank you to our expert panelists, Matthew, Hao Yao, and Chalin, for sharing with us your valuable insights. They don't hide anything from us. In fact, they've been very, very open, very truthful, share with us the read, share with us everything on this very important topic. of governing our charities reserves. And of course, May for moderating today's session. Well, before I close off, I'd just like to remind everyone to continue to approach us at CNPL for all board advisory matters. As a shared services partner of the charities unit, we are committed to journey with you to drive board excellence and governance. And we will be bringing you more Board Connect forums. The next forum is on the topic of the nominating committee or role, architect of corporate governance. And this will be taking place on the 17th of June. And EBM will be out soon for your registration. So do join us for this session as well. So I wish everyone the best and hope to connect with each of you really soon in person. Till then, take care, stay safe. Thank you.